Picture this. You hand someone $1,000 for safekeeping. You give it to them, fully expecting it to just sit there, right? Perfectly safe, completely untouched, just waiting for the exact moment you need it again.
But fast forward a year. You go back to retrieve your funds, and they hand you a modest yield, maybe $10 or $20. Not bad, right? Well, imagine finding out that the exact same person actually used your money to earn hundreds of dollars for themselves over that exact same year. Would that surprise you? Because honestly, this is remarkably similar to how modern banking actually works.
And that brings us to a surprisingly provocative question. Are banks actually making money off of your deposits? The short answer? Absolutely yes. But the full story of how they do it and why our entire economy literally relies on them doing it is so much more fascinating than just a simple yes or no.
Welcome to The Explainer. Today, we're diving deep into the money river, how the banking engine powers the economy. We're going to open the hood and uncover the actual mechanics of how banks operate, exactly where they earn their profits, and the incredibly surprising journey your money takes the second it leaves your hands. Let's get right into it. Section 1. The Giant Vault Myth.
So, when most of us deposit a paycheck, we kind of fall for this giant vault myth. We assume our money is just locked away in some massive, static room for safekeeping, just collecting dust. Well, reality check. It is far from that. Banks aren't these static, silent vaults. They are highly dynamic engines. They take the capital you deposit and actively deploy it, making loans, supporting local businesses, and financing homes. It's a whole system built entirely on keeping money in constant motion.
Section 2. Books, Borrowers, and Banks.
To really grasp how this constant motion works, imagine a small village. Some families have extra cash, while others desperately need funding to, say, build a house or start a business. The bank steps in as the vital middleman connecting them. It's actually a lot like a public library. Think about it. A library has thousands of books, but it works perfectly because not everyone in town checks out the exact same book on the exact same day, right? Banks operate on this exact same principle, which is the absolute foundation of fractional reserve banking. Because most customers aren't going to withdraw all their funds at the exact same time, banks can safely lend out a portion of those deposits while still keeping enough cash on hand to meet everyone's daily needs.
Section 3. The Interest Spread Bakery.
Okay, so how exactly does the bank profit from being this middleman? Well, creating that value is practically like running a bakery. Step 1, you buy your raw ingredients, like flour, for relatively cheap, say $5. Step 2, you bake some amazing fresh bread. Step 3, you sell that finished bread at a premium, let's say $7. And Step 4, you keep the difference to cover your costs and of course make a profit. Banks use a surprisingly similar model when it comes to your deposits.
In the banking world, that bakery profit is known as the interest spread or the net interest margin. It's totally crucial. It is simply the difference between the lower interest rate a bank pays you for keeping your money in their accounts and the higher interest rate they charge borrowers when they lend that capital out. After they cover their operational costs, any loan losses, and strict regulatory stuff, that margin is what directly feeds the bank's earnings.
Section 4. The Reality of Risk. Now, you might be wondering, if lending makes them so much profit, why don't banks just lend out every single dollar they hold? The reality is that lending inherently involves risk. It's never a guaranteed return. Some folks repay on time, some pay early, and some inevitably struggle to repay at all. Because of this, banks have to be super careful. They aggressively evaluate creditworthiness, hold capital reserves, and manage their assets responsibly to make sure they can always meet their obligations to you, the depositor.
Plus, lending is really just one piece of the puzzle. Banks generate massive income through a whole bunch of other essential financial services. We're talking about huge operational streams like payment processing, account fees, wealth management, investment banking, foreign exchange, and business banking. So while that net interest margin from loans is definitely vital, it's really just one part of a much bigger, highly diversified business model.
Section 5. The Money River.
Let's zoom out for a second and look at how all this moving money impacts the broader economy. Think of your local coffee shop. Customers pay for a coffee, and that capital is immediately deployed by the owner to buy more ingredients and pay the staff. The shop then uses the remaining profits to upgrade their equipment and expand. This constant movement, the velocity of money, is what supports all economic activity. Banks act as the central pump for this whole system, turning your stagnant savings into active mortgages, business loans, and real structural growth.
Seriously, imagine what would happen if capital just became completely stagnant. If we all literally hid our cash under our mattresses, the economic river would barely move at all. Families wouldn't be able to easily finance homes, businesses would struggle to borrow money for expansion, and broader economic growth would grind to an absolute crawl. Banks provide the vital infrastructure that keeps this economic river flowing, making sure capital is always working and moving toward productive goals.
Once you understand this system, it really clarifies why different financial tools serve totally distinct purposes. Your everyday bank accounts are best used for emergency funds and operational cash because they prioritize convenience, liquidity, and security. Investments, on the other hand, are designed to seek long-term growth, which naturally means taking on greater risk. Recognizing this distinction is super important for effectively separating your safe, accessible capital from your growth-focused assets.
And look, banks don't just earn these profits without doing any of the heavy lifting. Behind the scenes, they shoulder some massive systemic responsibilities. They're constantly managing complex credit risks, navigating wild global economic uncertainty, covering hefty operational costs, and actively preventing fraud. And they have to do all of this while ensuring strict regulatory compliance and maintaining public trust. The modern economy heavily depends on them sustaining this incredibly delicate balance day in and day out.
So, what should you really take away from all this? The next time you make a deposit, remember this: the most interesting journey your money takes actually begins the very moment it leaves your wallet. It embarks on this incredible path that literally powers the entire economy, helping households buy homes, helping entrepreneurs start businesses, and helping communities expand. So, I'll leave you with this provocative thought. Where is your money traveling today, and what is it helping to build?